Welcome back. This is the fourth video in the T3 Trading Edge short course. The course provides you with specific tools that you can incorporate right now today into your trading plan so that you can trade from strength. You need only claim your edge. The T3 Trading Edge consists of integrating 3 separate trading edges. Each edge has you looking to piggyback onto the strength of the dominant traders, not by guessing, but by letting the market first show its hand, and then and only then do you respond objectively to what you see. Why not put the odds in your favor? In the last video, I discussed trend. In this video, I discuss test, which is the second of the 3 trading edges comprising the T3 trading edge. The trend trading edge gave us which is the favored direction of trade when the market is trending or ranging sideways. The test trading edge identifies where we should be anticipating entering trades and where we should look to take profits on some or all of our trade. As the general rule for the test trading edge, we should look to enter and exit trades at key references on our charts. Price has 2 choices when it hits a key reference: reversal or continuation. Price testing a key reference represents our earliest opportunities to enter a trade. For exiting trades, the all-in, all-out approach is the simplest scenario. However, if you are anticipating trend continuation through a key reference rather than trend reversal, then you will likely use one of many different ways to lighten, then add back onto your position as price approaches this reference and then eventually continues on through it. That topic is well beyond the scope of this video. The test trading edge is by far my favorite of the 3. If as a trader this is not a central part of your trading plan, then in my opinion you are missing out big time. Institutional traders use key references, but only a small minority of retail traders use key references, or they only use just a few. To me, that scores bonus points for this trading edge. Day in and day out, price can be seen testing these references, giving good to great trade opportunities, if only a trader were to just look. I see it as opportunity hiding in plain sight, usually hours, days, or even months in advance. Better still, trading platforms and data providers make it cumbersome for a trader to see these references even if they wanted to, again scoring extra bonus points for those of us that use this edge. Some of these key references may even already be present on one or more of your charts, but you haven't yet been taught how to use the references from these charts in your trading. Trader education, for the most part, does not teach this topic. Many traders may have an impressive 4 to 6 monitor trading setup, but how many of these charts and indicators end up being essentially wasted space because they do not directly contribute to good trades every day? How many traders get confused with no idea what happened because they are completely unaware that price just hit and reversed strongly at a higher time frame reference? So stick around and let's go fix that. First, a pause so that you can like and subscribe to help others find their way to these videos. Plus, I extend a friendly challenge to you to encourage you to try what I suggest in this video for just 1 week. Then come back and leave a comment to report on how you made out. Did this not significantly improve your trading? Okay, back to the main event. Key references have several characteristics. 1. They can be either an exact price or a zone of prices depending on the type of reference. On a chart, that translates to a horizontal line or a rectangle. 2. Key references are important in both trading range and trending markets. 3. Key references have varying strength. Like for trend, think causation. For any given reference, always consider how many institutional and retail traders are using that reference. Remember to include all traders, so that includes investors and stock, options, and future traders on all possible time frames. Again, just like for trend, key references are stronger as time frame increases, from the smallest intraday levels up to the monthly or yearly time frames. There are many different types of key references. Different trading methods tend to each focus on just a different subset of the whole. Support and resistance traders tend to focus on prior swing highs and lows. Gap traders focus on the previous session close. Investors watch higher time frame moving averages, and the list goes on. My list of key references starts with the high, low, open, and close of the daily, weekly, monthly, and yearly time frames, both for the current and previous bars. Obvious major swing highs and lows are important too, and can go back in time a year or more and still be relevant. For highs and lows, again I think causation, and more specifically consider what do the US-based pit traders and all investors see. For the S&P 500 E-mini futures contract, that is RTH. The Asian and European session traders march somewhat to the beat of a different drum, so I track the overnight highs and lows separately. But in all my charts, you will always see I differentiate overnight from pit session trade. My daily, weekly, and monthly charts are all RTH, something for which NinjaTrader 8 has no built-in capability. Again, here is a bonus to this edge, that of being able to accurately track references that others cannot. For opens and closes, we have options. For the equity E-mini contracts, like ES, NQ, and YM, I only consider the 9:30 Eastern Time open. For the close, I have three choices. I ignore the recently revised RTH session close and instead use both the long-standing 4 p.m. and 4:15 p.m. Eastern Time closes. Next, I add the popular 20, 50, 100, and 200 period moving averages, widely used by investors on daily and weekly charts. Then I add open gaps, whether they be gaps on close or gaps on range. Both represent imbalances in price that the market tends to come back and repair in the short term. For ES, the 60-minute initial balance, like the overnight high and low, have a very high statistical probability of being traded through each RTH session. The initial balance, therefore, is also added to my key reference list. I also have VWAP and several market and volume profile references on my charts, given their wide use in trading. Lastly, I mark the origins of major news events. Yes, the list is long. Hence, I coded the tracker indicators to do all the heavy lifting by automatically tracking and plotting each reference for me. The indicators share information across charts too, affording me consistency in approach, minimize redundancy, and optimize computational efficiency. We have to pause here for a minute to backtrack and elaborate on trend lines and moving averages. I said key references were horizontal lines and rectangles, but trend lines and moving averages are neither. Trend lines and moving averages are causative on higher time frames of daily and higher, mainly due to the massive number of investors and higher time frame traders that use them. There's also very little wiggle room in what the daily S&P 500 chart looks like, or its corresponding trend lines and moving averages. From the perspective of a retail day trader of the ES futures contract, however, the 20-day EMA is just one discrete price represented as a horizontal line on any chart smaller in time frame than the daily chart. It is the same process to represent a trend line from the daily chart on, say, a 5-minute chart. In the trend video, I previously discussed how I do not consider trend lines and moving averages on intraday and lower time frame charts to be causative, so they do not count as key references. You can use them, and you might be wildly profitable, but it is a false narrative to just assume that all traders and investors use them. For example, when I invest, I use the daily and weekly charts, so I have absolutely no idea and completely don't care about any trend line on a 2000 tick chart. On this, I am confident that I am not the exception, but more the rule. Moving on, each session is like the key references are a deck of cards that is shuffled and dealt out onto the chart. Each day is different. In general, only several references will be relevant each session, but I don't know which ones until I see the particular hand dealt for the day, where the overnight price movement ended up, plus consider the market sentiment based on the recent daily trend, news events, and overbought, oversold conditions, collectively referred to as bias. At times, some references, like the weekly moving averages, won't be relevant in a strong trend for months. Quite a few days are golden, with an obvious plan for the day jumping right off the chart. And of course, there are days that are unclear, but having some advance insight is always great. I consider the key reference prices to be primary references. I expect traders and investors to enter, exit, add, and reduce positions near these references. As a result, I expect price to form secondary structures as it tests each reference for reversal or continuation, building or reducing positions along the way. Trading methods stemming from these secondary structures are what we know as support and resistance, supply and demand, and various smart money concepts, all of which we can loosely call variations on the same theme. These methods are fine. My enhancement is that I have more confidence leaning against a secondary structure when I can attribute its formation to a primary structure. As a tip, it is important to remember that it takes time to fill large orders, so a simple touch of a key reference is not good enough to establish that a reversal has held. You might get an initial strong reversal on the first touch, but expect price to return that day or over the next several days to retest, pause to fill more orders, and only then make a sustained move in one direction or the other. As per the last video, a stop hunt is a great way to fill large orders and ties in nicely with the test trading edge. I consider test to be the strongest of the three trading edges in the T3 trading edge because it taps directly into the strength of the higher time frame, even when day trading on lower time frame charts. For ES, this almost always occurs at least several times each and every session. When it comes to planning the upcoming trading session, trend should give you some idea of what you are expecting in terms of where price is currently within each of the lower, intermediate, and higher time frames and your expected favored direction of trade. The test trading edge should give you the layout of the key references that may be encountered during the upcoming session, and thus identify where price is most likely to test for reversal or continuation. For examples, I start with March 1st. The daily trend has been clearly down in all of 2022. This means we should be looking for an intermediate time frame rally up so that we can get short. Starting my trading session at 8 o'clock Eastern Time, it can be seen that overnight had rallied up. Price had reversed down from the key reference from the daily chart. Market structure on the intermediate time frame uptrend had also been broken. So while lower time frame momentum traders were thinking uptrend off the open, I was thinking intermediate time frame attempt to retest the high for potential market reversal to get short. I was also looking for a good location to get short. The previous month's close and the swing low where structure was broken were two obvious options. Two obvious profit targets were the two previous daily lows. The overnight low was also an obvious target with a near 100% probability of being hit. This is how I combined the trend and test trading edges that day. I hope the example serves to highlight how trade entry location and profit targets can be planned hours in advance of the trade. Here's a nuance that may not be immediately obvious. I have a daily chart and it contains important information, but I do not trade directly from the daily chart. The important price references are transferred automatically onto my intermediate time frame and lower time frame charts to expedite my trading. Great trade opportunities are only offered for a couple seconds, so the information has to be accurate and automatically on my lower time frame chart, so there's no delay in my hitting the button to enter a trade. A bit tongue-in-cheek, I will conclude that where trend is the trading edge all know but choose to ignore, test is the trading edge for which traders don't have the right information in the right place to be able to use it. To fix this, I suggest you go back to our causation discussion and use that to turn off all that unnecessary stuff on your charts that has nothing to do with causation for your specific trading setups. Next, start tracking some of the key references I listed earlier and prove that they work for yourself. Color code the references for ease of recognition. For the second example, we look at March 16th. The 15-minute chart said intermediate time frame uptrend, continuation in the overall daily downtrend of 2022. Again, I was looking for the intermediate time frame uptrend to end at a logical and obvious place for the daily downtrend to attempt to resume, or at least for a good intermediate time frame swing down. I was looking for a clustering of old highs for a good intermediate time frame stop hunt, so you can see why I considered 43.37 to capture at least 3 old highs. Tracker MP is my smart indicator for market profile, and it clearly identified the fresh gap on range of 43.37. So now I was very interested in a short here. Not for a tiny scalp of a couple ticks, but for an intermediate time frame swing down of tens of points. Now here's the 1-minute chart. Recall the sequence from the trend video of a trendline break followed by a retest of the high. Here we had a bull flag break the upwards trend line, fail to make a higher high, then break the lower time frame structure and retest again, which was my entry short. I favor structure breaks over trendline breaks in my market reversal sequence, which is why I waited. And then down we go some 70 points. On the way down, price paused at the previous week high, previous week open, overnight high, then the 20-day EMA, open, and finally the previous day high and previous day close. For both the March 1st and 16th examples, multi-time frame analysis of trends has us let price go up so it can go down from our predetermined location. And we short. We are shorting against lower time frame momentum retail long traders that have no idea the market has reversed until they have racked up a series of losses. For other examples, it is pretty much the same thing day after day, just with different references at play. Here are the references tested on March 18th, March 24th, and then March 25th, 2021. Pause the video to study each chart. March 24th is interesting because it shows how price can range between 2 references before deciding what to do. It also shows how a developing VPOC can form at a reference and then see price sell off from a retest of that reference. It's the confluence of the developing VPOC at the previous day's open that made me keen on shorting there. Here's a test of a fresh but old gap on range as price peaked below the low of January 10th on January 17th. The beauty of this trade is that the opportunity was long forgotten by many retail traders. It had literally scrolled off their charts. The June 16th gap fill attempt is another example of an obvious trade opportunity, but one likely also long forgotten by many traders. And again, here's one more from January 27th. Proof that investors use the moving averages can be seen here on a chart of the S&P 500. If we drill down to a 30-minute chart of SPY, you can see how the 50-day simple moving average and 100-day simple moving average coincided to daily lows and closes as traders and investors fought to defend those prices. Whether you chart SPY adjusted or unadjusted for dividends, you can also clearly see the precision investors had for testing significant previous swing highs and lows. Now let's look at 2 trading websites. First up is The Secret Mindset with over 500,000 subscribers. Here is a video suggesting that one look to enter a trending market at the key reference coinciding with the opening price. That is a great example of applying the first 2 of the T3 trading edges to enter a trade. Next is Al Brooks, who is a recognized price action trader that advocates trading a naked 5-minute RTH chart with just a 20-period moving average. His body of work is an excellent encyclopedia of one form of price action trading. He mentions here last week's low, and here he mentions yesterday's high, yesterday's low, and the open as important references. From these 2 websites, here is the issue you will have as a trader attempting to mimic the authors. These are not the only important key references, so your trader education has quite likely never shown you how to chart these references so that you can use them in real time for real trading. Here's the missing link. You need to have all the key price references that you consider relevant marked on your chart before you start trading as part of your pre-market preparation. So Al is correctly identifying why price reversed, but he is not teaching you how you can do this in real time on your own charts. Al also has a good blog on his website. His daily, weekly, and monthly chart analysis makes reference to highs, lows, opens, and closes, as well as the higher time frame moving averages. Again, if you want to trade these in real time, these references need to be on your charts in advance, and in such a way that you can act on them at a moment's notice. Go back to the examples I gave earlier and see how my charts are tracking these references automatically. The last thing to mention about key price references is the elephant in the room. There are far too many key price references, and some are not conducive to automatic calculation. Yes, we must each pick and choose which subset we will focus on that suits our individual style and capabilities. Pick too many, and conflicting information will tie us up in knots. Pick too few, and we'll be trading blind at times. Ideally, the references will be far enough apart that you can see the market's intention. If the references cluster too closely, expect some competing interests and thus greater sideways ranging until the winning side is resolved. On any given day, the preceding price action should show us which references are being used. This concludes the discussion of the test trading edge. In summary, trend and test are the first two core elements of the T3 trading edge. Trend informs us on which direction to trade, and test informs us as to where to enter or exit trades. The testing of key references is causative because it taps directly into the dominance of the higher time frame traders, even on the lowest time frame charts. Test applies to both trending and ranging markets. Expect price to test key references for continuation or reversal. Key references are represented as horizontal lines for exact prices or rectangles for zones. Key references vary in type and strength. Always think causation. Key references are primary structures around which secondary structures form. Identify key references on your trading charts during your pre-market preparation. And lastly, decide upon which subset of key references you will track. The next video will look more at the lower time frame price action that occurs as each key reference is tested for reversal or continuation. Thanks for watching. I look forward to seeing you in the next video.